It's Friday, October 31st, 2025. Welcome to your news update on Blip Brief, small but almost everything updated every weekday. Okay, let's jump right in. Yesterday felt definitely defensive for the main Indian indices. Both the Nifty 50 and the BSE Sensex closed down about 0.7%.
Yeah, a noticeable dip. And it wasn't really about domestic issues, was it? It felt like global headwinds hitting home.
Exactly. The anxiety seemed imported primarily from the U.S.
You've hit on the core issue there.
Yeah.
That drop was largely a reaction to the U.S. Federal Reserve. They sounded, well, pretty cautious about a December interest rate cut.
Pouring cold water on those hopes, basically.
Absolutely. And global investors, they react instantly. They started recalibrating risk, maybe pulling back a bit from emerging markets like India.
And you see that ripple effect almost immediately in the money markets here, right?
Precisely. The bond market reaction was quite telling. India's 10-year government bond yield saw its biggest jump in 6 weeks,
How much is that?
up 4 basis points. Now that might sound small, but it's a clear signal. It reflects those fading U.S. rate cut hopes and maybe some ongoing domestic liquidity concerns too. The cost of borrowing just ticked higher.
Okay, so the big benchmarks were flashing red because of these global macro fears. But, and this is where the Indian market often gets interested, the picture wasn't uniform. The broader market seemed less spooked.
That's the duality, isn't it? Real resilience in pockets. While the large caps felt the heat, some smaller segments actually gained ground.
Like which ones?
Well, the Nifty Small Cap 250 Quality 50 Index, it edged up around 0.3%, and the Nifty Mid Cap Liquid 15 was up about 0.2%.
So not huge gains, but positive. What does that tell you?
It suggests targeted buying. Investors who are still bullish on India's longer-term story, they're just looking further down the market cap spectrum, trying to find value perhaps untouched by that immediate global fear.
And this underlying confidence, it's not just local sentiment, is it? We've got hard data on foreign capital flows.
Absolutely. You have to look beyond the daily noise sometimes. Foreign portfolio investors, the FPIs, they continued to pour money in through October.
How much are we talking?
A really substantial inflow. Around Rs 21,286 crore for the month. That's a strong signal of renewed bullishness from foreign investors. They seem to view these dips as buying opportunities, not exit signals.
Okay, so foreign money is still betting on India, but are the companies themselves delivering? Let's pivot to corporate earnings. How did the big names fare? L&T, for instance.
L&T was a definite positive. It gained between 0.7% and 0.9%. And the why there seems pretty clear. Bullish brokerage reports focusing on its domestic infrastructure and energy orders.
Right. L&T is seen as a proxy for that whole government infrastructure push, the CapEx story.
Exactly. It's a direct play on that long-term domestic growth narrative, almost irrespective of the day's global mood swings.
And Coal India, another key player.
Coal India also had a strong showing, up about 1.5%. Demand for coal just remains incredibly strong with industrial activity and power needs running high. Simple supply demand, really.
All right, let's dig into the quarterly results now. Hyundai Motor India reported. How did they do?
Quite well, actually. Their Q2 net profit jumped 14.3% year-on-year.
What was driving that? Domestic sales?
Partly, yes, but the big drivers were strong exports and, importantly, effective cost-cutting. So maximizing external opportunities while keeping a tight lid on costs at home, a solid performance.
Okay, but the picture wasn't universally rosy, especially in consumer goods. ITC's results were a bit more complex.
That's right. Their net profit was up 4.1%, which sounds okay. But the top line, the revenue, actually dipped by 2.4%, and that missed expectations.
Any reason given for the revenue miss?
They mentioned something about U.S. tariff shocks. It's a reminder that global trade friction isn't just an abstract concept. It directly hits the bottom line for exporters, especially in consumer segments.
Interesting. Now, the power sector seemed like a really mixed bag. Some up, some down.
Yeah, very mixed. You had the power generators facing some pressure. NTPC's consolidated net profit fell 2.9% year-on-year.
And Adani Power.
Adani Power also saw a slip, down 12% on net profit. The commentary pointed towards higher expenses, fuel costs, operational costs, that sort of thing.
But then you had the Indian Energy Exchange, IEX, bucking that trend completely.
Exactly. IEX saw its net profit jump a solid 14%.
So why the difference? Why are generators struggling while the exchange thrives?
Because IEX isn't producing the power, it's facilitating the trade. It's a platform business. They benefit from higher volumes of electricity being traded, regardless of the input costs like coal or gas that hit NTKC or Adani Power.
Right, they're insulated from those production costs.
Yeah.
They just take a slice of the transaction.
Precisely. More trading volume equals more revenue for them. It shows the structure of the market is creating value, even if generation itself is under pressure.
Okay, let's look at the other side of the coin. Biggest losers. Pharma and telecom seem to take a hit.
They did. Dr. Reddy's labs dropped quite sharply, down 3.9%, and Bharti Airtel fell 1.6%.
Any specific triggers for these normally defensive sectors?
It's often hard to pinpoint one single reason day to day. For pharma like Dr. Reddy's, it could be anything from US FDA news, new generic competition, or pricing pressures overseas. For telcos like Airtel, it's often about intense domestic competition or maybe market jitters about future capex for things like 5G rollouts.
Got it. Okay, shifting focus now to the broader economy and currency, the rupee had a bit of a wobble.
It did. It touched a two-week low at one point yesterday, though it did recover slightly later in the day.
What caused the initial dip?
Mostly textbook stuff, typical month-end dollar demand from importers settling bills. Pretty standard pressure.
And the recovery, was that the market finding its level or something else?
Well, the recovery suggests possible intervention. It's likely the RBI stepped in, selling dollars to cushion the rupee's fall and prevent excessive volatility. They tend to manage sharp moves.
And speaking of the RBI, there were some interesting comments about the rupee's longer-term future, weren't there?
Yes, quite significant. The deputy governor mentioned that the internationalization of the rupee has, quote, begun. They pointed to exporters starting to invoice in rupees.
Why is that such a big deal?
It's strategically huge. If more trade is done in rupees, it reduces India's reliance on foreign currencies like the dollar, cuts transaction costs, lowers external risks, and it's seen as a crucial step towards India's ambition of becoming a developed economy, building that financial resilience.
Makes sense. Let's look at trade data quickly. Some mixed signals there, too.
Indeed. While overall exports like iron and steel seemed to hold up well, there was a specific dip. Engineering exports, particularly to the U.S., were down 9.4% in September.
So broad strength, but specific weaknesses emerging.
It suggests that while the core industrial machine is running, specific sectors might be facing headwinds, perhaps due to slowing demand or maybe even protectionist measures in certain key markets like the U.S.
And we also saw a very targeted policy move on the agriculture front.
Yes, quite surgical. The government slapped a 30% import duty on yellow peas effective November 1st.
Why yellow peas, specifically?
The clear intention is to encourage domestic farmers to sow more rabi pulses, particularly things like chana and masoor. It's using tariffs as a tool to boost local production and reduce import dependency for key food items, a direct intervention.
And on the government's finances, how are things looking? GST revenues.
That's been a consistent bright spot. GST collections remain strong, quite resilient, actually.
Even after those rate cuts back in September.
Yes, even after that big rationalization effort that lowered rates on most items, it suggests compliance is holding up and the tax system is becoming more efficient, which is, very positive for the fiscal outlook.
Okay, let's circle back to the markets, specifically capital raising. November looks set to be a huge month for IPOs.
Absolutely massive. The forecasts are suggesting over 86,000 crore worth of public issues could hit the market next month.
Wow. That's a lot of activity.
It is. Investment bankers are going to be busy. It also shows there's significant capital waiting to be deployed into the right opportunities.
And one of those, the Lenskart IPO, just opened today, generating quite a bit of buzz.
Definitely. The anchor book response was huge, apparently oversubscribed 20 times. And the gray market premium, the unofficial indicator of demand, surged to around 17%.
So very positive.
It shows the appetite for consumer tech stories.
Right.
But there's also that classic debate starting around valuation. Is the high price justified by the future growth prospects? Especially in this kind of rate environment, investors are definitely discussing that.
And another big name heading for listing soon is Grow's parent company.
Right, Billion Brains Garage Ventures. Their CEO talked about the upcoming November IPO.
What was the rationale offered?
He framed it less as just raising capital and more about accountability. The idea being when you're managing billions in customer money, going public brings a level of scrutiny, governance, and transparency that builds essential trust with users.
Interesting framing. Okay, let's broaden our view now to the global stage. Some major developments, particularly between the U.S. and China.
Yes, a significant summit between Trump and Xi. It resulted in what looks like a fragile but strategically important trade truce.
What are the key parts of that deal?
Well, the U.S. seems to be trimming some tariffs, a bit of a concession. In return, China has apparently agreed to crack down on the illicit fentanyl trade flowing into the U.S.
That's a big non-trade element.
Huge. Plus, commitments to resume large purchases of U.S. soybeans, reportedly 12 million tons immediately and crucially, to maintain exports of rare earth materials, which are vital for tech supply chains. So, it's a de-escalation on several fronts.
And how did energy markets react? Brent crude?
Brent futures actually dipped slightly, down about 0.31%, despite the U.S.-China news maybe easing some global growth fears. The oil market has its own dynamics.
But related to global dynamics, India secured something important geopolitically, didn't it?
Yes, a really critical win for India. It got a 6-month extension on the U.S. sanctions waiver for the Chabahar port in Iran.
And why is Chabahar so vital for India?
It's key to India's regional connectivity strategy. It allows access to Afghanistan and Central Asia, bypassing Pakistan. So, keeping that port operational and free from sanctions is a major logistical and strategic priority for New Delhi.
Okay. Now, turning to the U.S. itself, there seems to be growing anxiety among tech professionals there, particularly those on visas like the H-1B.
Yeah, it's a worrying time for many. There are a couple of factors converging. First, the lingering threat of a U.S. government shutdown is delaying visa processing, creating uncertainty.
And second,
And perhaps more impactful, is a specific rule change affecting spouses of H-1B holders. The U.S. is ending the automatic extension of work permits for H-4 EAD holders.
what does that mean practically?
Experts warn it could lead to thousands losing their jobs quite abruptly. It removes a layer of stability for these families, many of whom are highly skilled professionals contributing to the U.S. economy. It creates real instability.
A difficult situation for many. And finally, a brief but sobering update from the conflict in Europe.
Yes, unfortunately, Russia launched another major assault on Ukraine's energy infrastructure, using drones and missiles. Reports indicate 7 fatalities.
And the impact on power.
It's forced nationwide power restrictions just as winter is setting in. It highlights the strategy of targeting critical civilian infrastructure, making conditions incredibly difficult.
A grim reality. Okay, let's wrap up, as we always do, with a look at a major tech or science innovation. This week, it involves 2 giants, Reliance, Geo, and Google.
This looks like a really aggressive strategic partnership aimed squarely at the Indian consumer AI market.
What's the deal exactly?
Reliance Jio is partnering with Google to offer its 5G customers free access to Google's Gemini Pro AI subscription for 18 months.
Free access, how much is that normally worth?
It's valued at around Rs 35,100, so it's a significant giveaway.
What's the strategic thinking behind making such a powerful AI tool essentially free for so many users?
It seems like a massive play for market adoption. By putting Gemini Pro into the hands of millions of its 5G users, Reliance Jio, with Google, is trying to rapidly scale up the use of sophisticated AI in India. They want to normalize it, make it part of everyday digital life for their massive user base, potentially leapfrogging basic AI assistants and embedding advanced AI deeply into the Indian digital ecosystem. It's an attempt to capture the future, really.
A bold move to shape the AI landscape in India. Fascinating stuff. And just before you go, a quick note. This deep dive commentary was put together using advanced AI. We always strive for accuracy, but please do cross-verify any crucial information yourself. Your informed decisions are what matter most.